Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I offer in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Well, good afternoon all. Ira Epstein of Linn & Associates with your financial market update for this Monday, the 20th of March, 2017, and what an interesting day. I don't know if you were doing what we were, but thank God March Madness is off because all these boys would have been crazy here, and girls. What we were watching, of course, was the House committee and the drilling of Mr. Rogers, Mr. Comey, if you will, and what it all means. Well, I think President Trump had a very bad day. No wiretaps. They're looking at his campaign. Is it involved in any manner with Russia? Both things he didn't want to hear. You know what the market did? It shrugged it all off. It doesn't care. The gold got a bid along with silver. The dollar was stable. Nobody ran to it or ran away from it. Euro's not going anywhere. It became a quiet session. You had more action in the energy because we keep adding the rigs, and what they keep going on there is OPEC is now saying, well, they'd like to continue, but they need non-OPEC members. If they're asking America to cut back, I don't think that's going to happen. Russia, yeah, maybe a few others, but I doubt that you're going to get America to cut back. We want them to do the cut so we get market share. That seems to be the thinking. In the E-mini S&P, I think you'd agree, we have consolidation on a weekly chart. Look at all these weeks where we're just now sort of staying here, not moving away one way or the other. When we look at an area chart of closes, you've gone from right at the end of 2016 with 22.50 to a high of 23.97 and a quarter. And from there, you've backed off in round figures about 27 points and just sort of hanging here as the market's trying to figure out, is this a base or a top? If it's a top and you start busting through here, you could get a 5 to 10% correction at any point. A lot of people think the market's a bit ahead of itself and overvalued. On the other hand, it's hard to get short a market because what if healthcare goes through? If it goes through, the next thing is going to be the tax cuts, and what we have is a negotiating president. He also is the Teflon man. They can throw things at him, and it doesn't seem to stick. It's hard to be short on, right? When you look at the daily bar chart, you can see how you came up and you're just drifting sideways right now. But when you add the swing line study, and that's what this brown line is, you get a very clear pattern of higher lows, higher highs, and that pattern's only broken if you take out 23.54.75, which means that's the risk to the longs. If you break that pattern, you end up with a higher high and then a lower low, which is no trend at all. In terms of support, you're right on it. Often, you will see me in these videos talk that I believe that the key line on a chart is the 18-day, on a daily chart, moving average of closes. It's the reset. It's the line in the sand. When you get to it, it's the thing, or the line, if you will, the number, the study, that markets seem to work away from. In other words, this sets it up, and then you start moving away from there. Now, at the same time that we've been hitting this fairly often, the Bollinger Bands, which is what these are, these black dashed lines, have gone sideways. The math of them looks at volatility in the market, what it's doing, and all of a sudden it's come in. When that occurs, you often become what I call not chop suey, but chop city. You just start chopping around back and forth, a lot of false moves. We might be in a period like that. You got to be careful. When you look at momentum, momentum's pretty much neutral. If anything, it's trying to turn down. I can't say that it has. And any readings by 50 are neutral. So momentum is not leading price. It's just sort of drifting with it right here. When we come to the Dow, at least I can argue you've had downside momentum. You can see how this market, too, is stuck against the 18-day average of closes as you're narrowing in these Bollinger Bands in a very dramatic way. Whenever I see that, you get this type of action. And if you were trading in this, you got very frustrated. Eventually, it breaks out, and all that sideways compression forces the market one way or the other. Which way will that be? That's your guess at this point. A lot of option traders will take this area here and do things with the options, betting that it'll burst out of it one way or the other. It's not, when you see these Bollinger Bands, a smart move to write options to collect premium because it's going to break out one way or the other. When we come to the NASDAQ, you have a market that's got a lower low, a higher high. It's not trending. It certainly has been riding the upper Bollinger Band, and it looks like today it's going to lose its embedded reading, which because it's just by a fraction, any reading under 80, it can gain it back tomorrow. If it stays lost 2 days in a row, the odds strongly favor price and the 18-day average coming together. And notice what's happened, that narrowness again. What about the Russell? Well, the Russell's not as narrow as the others. It has been the bad poster child. It was the market that went down as the other indices were going up, but it ran into this 18-day average of closes, and lo and behold, it has just run out of its momentum. So we're seeing something that all the markets went to their 18-day average in the stock indices, and they're sort of stuck looking to see what they do next. In the VIX, here is the opposite of what I said. If you'd been writing premium, taking in the premium, these people have won. Now, when you break out of something this long, when it eventually moves, be it to the upside or downside, it's going to be a heck of a move, because this is like a spring all wound up in there. When, how, I'm not even beginning to tell you because I don't know. I can just tell you what it's doing, and you don't have anything going. You've got a pattern of higher lows, higher highs. That's bullish. You're under the 18-day average. That negates it, and momentum is just about flat as can be. When we come to the bond market, you've got now a slight upward trend. You've got higher lows, higher highs, and you're closing, from the looks of it, over the 18-day average of closes. When we take a look at the 10-year, this is in an uptrend. Higher lows, higher highs, over the 18-day average. So the pros aren't going to want to see 123, 11.5, the lows of Friday taken out, and the same in the 5-year. You don't want to see those lows. And in the dollar index, you're still very much in the bear camp with lower highs, lower lows. You had 2 days in a row under the lower Bollinger Band. You've moved to the right-hand side where you belong in it, and that just means you have a market in a downtrend. It is oversold, but anyone that says this is trending higher, I don't know what they're looking at or what they're smoking. It isn't. On a daily chart, it's definitely in a downtrend, as the euro's been in an uptrend. Higher lows, higher highs, riding the upper Bollinger Band the other way, overbought. A mirror, the other side of the image, to the dollar. In the British pound, one of the other elements I try to point out to you is these first attacks of a 100-day average often are false. And again, trying to get over it would have been the false part. The market still has a problem here. It looks like it wants to pull back to the 18-day average to figure out what to do. There is no trend. You have a lower low and a higher high, and you are not yet overbought, but probably tomorrow, if you're up at all, you'll hit that overbought category. In the Japanese yen, higher lows, higher highs, staying over the 18-day average, very overbought. I wouldn't look for much more than the 100-day average in that type of chart pattern. Very dangerous. Then we get to the crude oil, where now we're starting to see the open interest collapse again. If you'll recall, a month ago, the big bet everybody was putting on was they were buying, be it options, futures contracts. The open interest was exploding as traders were looking for this sideways action to carry the market to higher prices. Remember, stock indices that we're just talking about? I want you to look. When you break out of a pattern, it gets rather nasty, doesn't it? See what I'm getting at? So that's what I'm looking at in the VIX at this point. Which way does it break out? You can see this broke out to the downside. The market's still embedded, so it's still got plenty of power here. When you lose the 18-day average and it's over 20, then I'll say maybe prices can make a run back to between the 18 and the 100-day average. Right now, a lot of pain, a lot of people wrong on those bets. When it looks that easy to do, it rarely is. Now, a market that today I told my subscribers to stay away from on the short side of the market, even though it has an embedded reading, is gasoline. gasoline from anywhere from mid-March until early June. It's one of those markets that you're looking for where the retailers start buying more, where the weather starts clearing up from this nasty weather that you've had on the East Coast. And when that happens, the demand comes in because people want to go out, they want to do things, and gasoline demand picks up. Just a market that even though the trend is down, sometimes you avoid certain markets. And in nat gas, I'm going to stick with my argument that we were talking about. On a chart, this still looks like a bottom area. You came back, you challenged the 18-day average, didn't quite hit it, you're overbought. Now you're coming back into key resistance, the upper Bollinger Band and the 100-day average of closes, but the trend in that still remains to the upside. Now, interesting, because you're going to see our April issue, or the April issue of Modern Trader magazine. And by the way, Market Focus is how they keep you up to date with daily stories. You know, you put out a magazine, you start writing it typically. I owned a magazine years ago. It could be 3 months ahead of time. And you're doing your stories, figuring where you're at. But what do you do to keep up every day? Well, that's what they do with their the focus part of it. But you get all these different ideas, and it's from ETFs, the stocks, cycles. It's name it. If you're a technician, it's there. Here's the platinum gold spread. Which way do you go in that? It's must reading. Trading symmetric chart patterns, the triangle pattern, a very, very interesting one. How do you work with it? What's the pattern to call for? And again, that Market Focus, your daily magazine, free. Go to their website, get it, $79, free from us. How do you get it? Call us. You can go to our website, you'll see a carousel of free offers. Click up here, and what happens? When you click up this icon, if you're watching me on YouTube of any type, just click it, the form will appear, fill out what you want. It'll come back to us, and underneath us on many websites that pick us up, they'll have our form. It says click here, and it'll all link in. You have a great day. Thanks for watching, and I'll see you tomorrow.